Hello everyone, this is Day Trader Matt, and today I wanted to talk about options. We're beginning to show our options trades in the room. It just gives another form of investment, and instead of just day trading, it gives a longer term outlook and allows you to hold things for a longer period of time, and it's a whole lot less risky. You're really minimizing your risk and maximizing your profits. So I wanted to talk about it a little bit. A lot of people are new to options, or they don't know much about them, or they've just been confused by somebody trying to explain it to them. Whatever the case, I'm going to talk about them a little bit. Um, let's start with what are options. An option is a contract between two parties that grants the buyer the right but not the obligation to buy or sell at a future price. And I wanted to look at the example of a coupon book. Okay, let's say you're sitting at your house, right? Someone knocks on the door. You go, you answer the door, or maybe you look through the window to make sure they're not a psycho, and then you open the door, and it's someone selling a coupon book. That's cool. So you look through the book, and you look and you're like, oh well, I've some really good deals. So you pay for the book. Let's say it's $30, for example. You pay $30 for the book, and then you see that let's say hypothetically you love chicken. I love chicken, so we'll just stick with that. Okay, so let's say you love chicken, and you see that the chicken you buy is usually $7.99 at the store. Well, the coupon book that you just bought for $30 gives you a coupon for $4.99, so you're saving $3. Okay, so you're like, well, that's really cool. I would like to get some chicken now. So you go to the store. So you're thinking, I'm saving $3. That's pretty cool. So on the way to the store, you hear that there's a chicken disease out there that kills a lot of the chickens. So chickens, they raise the price naturally because they have less supply of them, and there's a chicken frenzy going on. So that $7.99 chicken, when you get to the store, it's $10.99. Well, your coupon still says $4.99, so you're still getting a good deal. Well, let's say the chicken frenzy is just getting really crazy. So that chicken, that $10.99 chicken, they automatically raise it to $13.99. Well, you still have that coupon for $4.99, so you're still happy. So, you get the chicken and you're heading to the register, and you buy it for $4.99. Great. Well, let's say you have another coupon in there for a $4.99 chicken. Say somebody offers you $7 for it. So what you're basically doing is selling them an option. You're selling them a $7 coupon so they can buy a chicken for $4.99. So that's basically what it is. That's basically what an option is. And we're going to go through some examples to show you a little bit more in detail. And, hopefully that makes sense a little bit. Okay, let's go to the next slide here. And I wanted to talk about option terminology. There are two types of options that I like. I like to buy call options and to buy put options. A call option grants the investor the right to buy at a given price on a future date. That's, call. If you think of, call, it gives you the right to buy at a future date. And a put option, you're giving the right to buy to someone else. So put option grants you, the investor, the right to sell at a given price on a future date. So if you think of put, you're putting it up, you're going to sell it for a future date, and then call, you're going to buy it at a future date. Those terms aren't hugely important, but I mean, if you're talking to somebody on the phone, then you want to, talk about that, and just know the difference between a call and a put option. Okay, you have an expiration date, which is very important. Let's say, well, let's do the definition first. The expiration date is typically the third Friday of the expiration month. If the Friday is a federal holiday, it would fall on Thursday. Technically, the expiration date is the third Saturday of the month, but the last day to trade them was on Friday. So it really doesn't matter. Friday is the last day. If it's expiring that day, that's the last day to trade it. For example, if you were to buy April calls, the third Friday of April would be the last day to trade those before they're worthless. So that's the expiration date. And then you have the strike price. It's the price at which the option can be called upon to buy or sell the underlying asset. For example, you buy, let's say, Microsoft calls, 35 calls. Microsoft 35 April calls, let's say. So your strike price gives you the option to buy Microsoft at $35 a share if you want to exercise it. I never exercise options. I don't believe in exercising options. You get in, you get out, you make money. Some people like to, and that's why it is what it is. But Microsoft April 35 calls, uh, the third Friday of April will be the last day to trade them, and you could exercise them at $35 a share. Say for example, let's say Microsoft is trading at 35, and you bought let's say it happened in February. You bought the April 35 calls, and then in April, Microsoft was trading at $38. You could sell those calls for profit. But you would not need to exercise and actually buy the shares unless you really think something's going to happen long term and you want to own those shares. The way that I trade and the way our room trades options is we would have sold that option for a profit. So that's how that works. Now I want to talk about how options are valued. You basically have two types of values. You have your intrinsic value and your extrinsic value. Now some of you may already be aware of these terms. Maybe you're a mathematician or something like that. But intrinsic value is basically how much the premium is represented by the current price of the underlying asset. Now to talk about that a little further, let's say, well, I'm going to get into some examples later, but just for simplicity's sake, let's say those 35 Microsoft calls that we bought, let's say we bought the 35s when Microsoft was trading at 37. So that gives us $2 of intrinsic value. It's how much we're trading around the strike price, basically. So that's what the intrinsic value is. The extrinsic value is the premium markup, and it's determined by the length of time remaining prior to the expiration date. And I'm going to get into some examples in a minute to show you the differences of that. Okay. Now we're going to talk about how call options are valued. And it's a very simple example. Let's suppose a stock is trading at $33 per share, and we look at the strike prices below. Okay, first one's at $30 strike price. We're trading at $33 a share, so we're in the money by $3, so that we have an intrinsic value of $3. The option is actually trading at $4.50. So that means there's an extrinsic value of $1.50. And remember, extrinsic value is, a lot of people call it the time premium. So the premium on that option is $1.50. So you're paying $1.50, for a 30 strike. Okay, our price is at $33 a share, and we look at the $32.50. So 33 minus 32.50, we have 50-cent intrinsic value, and the premium to buy the option costs $2.50. So there's $2 of extrinsic value. And then then we look at the example 35 strike. There's zero intrinsic value, but the option costs $1. So you're paying $1 for extrinsic value. And the way that I look at it is extrinsic value, paying for extrinsic value is not necessarily a bad thing. The bad thing is paying too much for the extrinsic value. So that's one thing you want to be aware of when you're looking at prices. And alright, now let's talk about how put options are valued. And we're going to suppose a stock is trading at $33, just like the prior example. Keep it easy. And let's, remember, a put option gives you the ability to sell. So anything above 33 is going to have intrinsic value in a put option. So let's start at the bottom of this chart. So 35 minus 33 is 2. We have $2 of intrinsic value. The premium for the option is at $3. So we have $1 extrinsic value. Okay, at 32.50 is below 33, so we have 0 intrinsic value. We're paying $2 premium, so there's $2 extrinsic value. Just like in $30, it's $3 less than 33, so there's 0 intrinsic value, and it's further away from the 33 strike price, so there's only $1.50 premium, so the extrinsic value is $1.50. And now, before I go any further, I wanted to talk about how options are actually priced. $1.50 option, because one option gives you the ability to control 100 shares. So a $1.50 option is actually going to cost $150, and then whatever the commission is, it depends on what platform you're trading on. So that's one thing you want to look at. You want to make sure you know what you're looking at before you actually get into an option. Okay, and this is my screen. I use Thinkorswim, and I wanted to look at some options just to be able to talk about them a little bit, and how you read them. Now on Thinkorswim, you can kind of set this up however you want. I have the bid here and the ask. These are my calls here, and these are the puts over here. You can set up how many strikes you want to see, all of them. 7's highlighted. You want to stay around the money. So that, right now, your 136, 137s would be at the money. These would obviously be in the money. So these would have intrinsic value. And these would have 0 intrinsic value. So that's basically what we're looking for as far as what we're looking at. Let's do an easier example. We'll stick with Microsoft. We'll stick with Microsoft to see what we're doing. So 31.22 is the price right now. So 31 would have 22 cents of intrinsic value. $30 would have $1.22 of intrinsic value. So $1.22, you're paying 65 cents right now, probably 66 cents of extrinsic value to buy this. So that's, whenever I'm buying options, I don't necessarily look at that, fully, but, that's one of the things that, main thing you're going to have to look at. I don't look at, your betas and thetas and zetas and all that, all your Greeks and all that, because I don't try to have an option weighted portfolio. I don't trade like a mutual fund manager, or, how, people trade like that. I want to get into something, hold it for a little while, and then get out. That's all that I'm looking to do. On the call options, we buy on the ask and we sell on the bid. So that that's what we look at here. Same over here. we're going to buy on the ask and sell on the bid. It's the same with futures, same exact thing. But that's basically how that works. When you want to buy, you would click on this buy, and then it would come down, and I'll show you on Thinkorswim real quick how it would work. You would left click buy, and it would bring this up, and you can actually limit your prices. You can how many calls you want to buy, 10, 12. Do you just want to buy one? What do you want to do? And then you would hit confirm and send down here. Which I want to hit delete because I don't want to buy anything. I'm just trying to show for examples. And basically the other definition that I didn't give, like I said, these are in the money. Anything with intrinsic value is in the money, and then you would consider these two at the money because it's trading between 31 and 32, and then anything out here with zero intrinsic value is considered out of the money. So those are the three different types of options, and it should actually give me a I know some option platforms will actually ask you, do you want to see in the money options, out of the money options? This is the Thinkorswim platform, and like I said, it's down here obviously. But it just tells you what is available, how many strikes do you want to see, and it puts in the middle at the money. So you can see what's going on. But anyway, that's the basic overview of options. If you have any questions, definitely put them below this video or email me at support@abusinesswithtrading.com. You can go to my website. On the upper right hand side, I have a contact form. So shoot me out any questions you might have. But that's the basic overview of options, and hope you learned something. Hope you enjoyed it. If you did, please click the Twitter, Facebook, and like buttons. Have an awesome day, and I'll talk to you guys later. Thanks.